Welcome back. So, let us continue from where we left off yesterday. Before we do that, a quick review, quick recap of what we had discussed in the previous lecture. So, a large portion of yesterday's lecture was devoted to examining the philosophical issues associated with the distinction between debt and equity. As I mentioned, equity implies ownership. Equity shareholder, even if he holds one share, is a part owner of the company, whereas debt implies lending. There is a contract of lending and borrowing between the issuer of debt and the holder of debt instruments, debt securities. An underlying contract of lending and borrowing subsists, a loan agreement or what is called an indenture subsists between the two parties. However, this is the technical distinction between debt and equity. At the philosophical level, we need to note that in the case of equity, it is the equity shareholder who takes the substantive business risk, whereas in the case of the in lenders, the risk is confined to the issue of default or the possibility of default in the recovery of the principal and interest thereon. Naturally, from the point of view of the lenders, because the repayment of debt and interest enjoys a preemptive right over payments or of equity dividends or of equity capital, the risk associated with the lending is less for the lender compared to that faced by the borrower. From the borrower's perspective, of course, debt is more risky because as I mentioned, the interest on debt is a charge against the profits. It has to be arranged for, or it has to be debited to the profit and loss account, irrespective of whether the company is in profit or loss. Then we also discussed the issue of agency costs, the costs that arise out of taking suboptimal decisions due to the conflict of interest between the lenders and the equity shareholders. And then interest usually, not essentially, is a fixed rate payment. In most cases it is fixed rate, although we have innovative instruments which carry interest at rates which are tagged to certain other underlying instruments. We will talk about them later on in this course. Dividend is discretionary. Dividend is an appropriation of profits. Interest is a charge against the profits. This is the fundamental philosophical distinction between debt and equity, that interest is a charge against the profits. It has to be debited to the profit and loss account like all other expenses, irrespective of whether the company ends up in profit or loss, whereas dividend is a distribution of profits. Normally you would distribute dividend only when the company has earned profits for the year. Of course, if there are accumulative reserves, then they can also be used. Uncommitted reserves can be used for the payment of dividend. Nevertheless, dividends are essentially an appropriation of profits, and because they are an appropriation of profits, the income tax legislations do not treat them at parity with expenses, while interest is treated at parity with other expenses and is allowed as a deduction when we compute taxable income, thereby resulting in a lower tax liability. The dividends are not so allowed. And this phenomenon of the interest being allowed as a tax deductible item is known as interest tax shield, because it results in a reduction in the tax liability of the company, and this reduction in tax liability due to the debit of interest to the profit and loss account or to the computation of taxable income is called interest tax shield. This was the example that we discussed yesterday, but the major issue, the major takeaway that emanated from the discussion yesterday was that when you take debt, or when a company engages in leverage means the use of debt in lieu of equity. When a company engages in leverage, higher the amount of leverage, higher is the magnification of the results of the company, irrespective of whether the results are positive or negative, irrespective of whether the company has earned a profit or incurred a loss. The results would be magnified, the outcome would be magnified if the company is levered. The more the leverage of the company, the more is the magnification of the outcomes of the operations of the company, that net results, the bottom lines of the company, irrespective of whether, I repeat, I reiterate, irrespective of whether it is a profit or a loss. So, in fact, that is the significance of the use of the word leverage. Leverage actually arises from the word lever, which is a mechanical device to magnify the efforts at one point to and its transmission to another point. So, there similarly leverage or the substitution of equity by debt leads to magnification of the outcomes of the performance of the company. Then there was the issue that we discussed, that equity acts as a cushion for debt, cushion for lenders. The thicker this cushion, the lesser is the risk of the lenders, and the more willing the lenders would be to lend money to that company, and as a result of which the company could get debt finance at a lower cost. However, if the cushion is thin, in other words, if the debt equity ratio is high, there is low equity and high debt already in the company, incremental lending would be viewed upon negatively by the lenders, and even if they do end up lending to the company, that lending would be at higher rates of interest, because the lenders would perceive lending to this particular company, which has a high debt equity ratio, as highly risky lending. And in fact, higher the leverage, higher would be the price demanded by the company, higher would be the interest rates demanded by the lenders when they lend money to such companies. And another fallout of this cushion aspect is that in adverse times, the higher this cushion, the greater is the sustainability, the greater is the possibility of survival of the company, because you see, the point is, when you borrow from at fixed cost, when you borrow from lenders at fixed cost, you have to debit it to the profit and loss account irrespective of performance. So, the losses get magnified in adverse times. However, if you are totally equity financed, then there is no debit on account of interest to the profit and loss account, as a result of which the outcomes of the company are not adversely affected to that extent, and for example, the losses would be confined to operational losses. There would be no debiting of interest and magnification of those operational losses by the use of debt. So, the takeaway or the outcome of what I am saying is that if a company has a low debt equity ratio, it would have greater chances of survival, greater chances of sustenance in adverse times. Can we have equity free companies? Well, we have talked about debt being cheaper, relatively cheaper than equity. Why? Because the risk faced by lenders is lower than the risk faced by equity holders because of the preemptive rights. So, the issue arises, can we have totally debt finance companies? Well, obviously, we cannot, for one reason, at least one obvious reason, and that is that you need equity to float a company, but this is a trivial reason. At a more philosophical level, at a deeper level, you cannot have totally debt finance companies, for the simple reason that nobody would be willing to lend you money if you do not have an equity cushion, because lending money to a company which does not have equity tantamounts to the debt holders taking the substantive business risk. You can see from this particular example, which is a carry forward of the discussion that we had yesterday. Here, if you have let us say you have start with a capital of 0 and you have a debt, the company is totally debt finance, or you have an infinitesimally small equity capital and a large debt capital, then what will happen in the event of any loss of the company, because there is no equity capital to back up those losses, to absorb those losses, the entire loss would be transferred to the debt holders. The loss in the business loss as it is would then be faced by the debt holders, because they would not be able to recover their principal and interest. You would like to recall here the issue of limited liability. If the equity capital is small, then the lenders have to face the risk. Why they have to face the risk? Because the equity shareholders cannot be asked to bring in more than what they have taken up in terms of shares in companies which are limited by shares. So, if the company is limited by shares, as indeed most of the companies in the in commercial arena are, most of the companies, almost all companies that operate in the industrial and commercial arena are companies that are limited by shares, and in these companies the liability of shareholders is confined to the total value of shares, that nominal value of shares that they have taken up. So, they cannot be asked to bring in any more money, and because they cannot be asked to bring in any more money, and if there is a shortfall on the liquidation of assets of the company, then that shortfall has to be naturally borne by the lenders. So, smaller that amount of equity capital, the more risky and the more reluctant the lenders would be to lend money to the company, and therefore, the issue of debt free companies really does not arise. I am sorry, the issue of equity free companies does not really arise. A word about limited liability. We discussed this concept in detail. The issue of limited liability, the liability of shareholders who have invested money in the company is confined to the nominal value of shares that they have taken up. If they have taken up fully paid shares, then their liability is completely extinguished. They cannot be asked to bring in any more money in relation to their shareholding, irrespective of the performance of the company. Why this is necessary? Well, this is necessary for the simple reason that shares are normally traded, and if the shares, if the liability of shareholders or liability of people who have invested in shares of a company was not limited, then there would hardly be people willing to take up shares or willing to buy shares in the market, because then if their liability is unlimited, naturally they would be extremely reluctant to invest in the company, particularly at small numbers where they do not have any significant say in the decision making process of the company. So, in order that shares are traded without any inhibitions, without any impediments, it is very necessary that the liability of those who are investing in the company is clearly defined and is known in advance, and this is the backdrop of why the concept of limited liability came into existence. Well, while we do not have equity free companies, and we indeed cannot have equity free companies for reasons which I have just explained, we do have, and indeed several reputed companies have very little debt or negligible debt on their balance sheets. The reasons arise from our discussions on this topic, which we have carried forward from the last lecture. Normally debt is associated with debt covenants, and there are managements who have the philosophy of total freedom in operations and who are not willing to accept any covenants, any restrictions which may be imposed by lenders. And if the company is well to do, if the company is doing well, then obviously they would rather prefer going for an equity issue to fund future operations if the need so be, compared to taking up debt for the simple reason that they do not want to be bound by covenants, by encumbrances arising from the indentures in relation to debts. Then agency costs, which we have discussed, the possibility of conflict between the motives, between the interests of lenders vis-a-vis the owners of the company. If a company has lendings and the lenders have some say in the company, for example through nominee directors, there could be conflict of interests of those nominee directors compared to the promoters of the company, and as a result of which suboptimal decisions may be taken. Costs of bankruptcy may be significant in some cases. If the company goes bankrupt, then the costs of liquidation, as I mentioned just now, if a company is debt finance, its survival prospects in case of adversity are lesser compared to a company that has equity financing, because equity has a lower fixed charge, and therefore it can go through, or it can pass through times of lower production and poor economic conditions, compared to companies which have debt financing, which need necessarily to pay interest to the lenders. So, companies which are equity finance may not have to face those types of bankruptcy costs, as indeed companies that are having significant debt capital and they get liquidated at the instance of the creditors. Then of course, there is that intangible condition or latent condition that debt free companies are viewed upon positively by the market. There is a positive image attached to companies that have lower debts. For example, we can take the case of Infosys, which has a very low debt, a negligible amount of debt on the balance sheet, and this contributes significantly to the high esteem in which Infosys is viewed by the investing public. Before we move forward, some items of nomenclature that we normally use. The debenture is one such term compared to a bond. Bond is obviously more common. Although in India they are used interchangeably, debenture usually refers to debt offerings by companies, whereas bond is a broader term which can refer to debt offerings by the government, state governments, by municipal corporations, as well as by bodies corporate companies and trusts as well. So, debt instruments which are offered by a wider class of organizations are termed as bonds. Debenture is a slightly narrow term which applies to debt offerings by companies. The second important difference, which is normally not well known, is that bonds are usually secured by some assets of the company. Bonds when issued are secured by some sort of a security in the form of either a fixed charge or a floating charge on the assets of the issuer, whereas debentures are usually again I repeat, usually unsecured, and the marketability of the debentures are usually associated with the creditworthiness of the issuer as a whole, as an enterprise, rather than being tagged to any particular set of assets of the company. So, bonds are usually secured by the assets of the issuer, debentures are usually unsecured, although we do have secured debentures also, but usually debentures are in the nature of unsecured debt instruments. So, that is the basic difference between these two instruments. Debenture is usually secured, usually unsecured, bond is secured. In India, of course, they are used interchangeably. Debenture usually refers to debt offerings by corporates, companies, that is, whereas bonds refer to a broader class of debt instruments, which include offerings from the government, the state governments, the municipal corporations, and so on. Now, there is another point that which I would like to discuss, which is the difference between stock and shares. This is another term which is not really very well understood, so I will devote a minute to discussing this point. As far as stock and shares are concerned, a stock is a collection of shares. For example, if somebody holds a number of shares in a company or a number of shares in different companies, he would be said to be invested in stocks, whereas share is the lowest denomination in which the ownership of the company is split up, and in which the trading is done, or in which the share capital of the company is denominated, so that this represents the smallest fraction of the ownership of the company which can be transferred or which can be given to a particular investor. So, in some sense, stock is a collection of shares. Those shares may of course be of a particular company, or the shares may be of a number of companies taken together. So, share refers to a unit of ownership in a single company, it's the smallest unit of ownership in a single company. So, in other words, we can also say that each unit of stock is a share. Now, usually stock represents to fully paid up shares, whereas in the case of shares, the shares may be fully paid up or the shares may be partly paid up. Then as I mentioned, share is a part of the ownership, but the shares also connotes a wider sense in the sense that when we talk about shares, we not only do we talk about the ownership of companies or the smallest denomination of ownership of companies, we can also talk about shares in a mutual fund, we can talk about shares in an investment scheme, we can talk about share in a limited partnership, real estate and so on. So, shares are have a wider connotation, but the basic thing is that they are the smallest units of those wider investment avenues, whereas stocks represent collections of shares, and in fact share is the smallest fraction of a stock. Stocks could be a collection of shares in many companies, not necessarily one company, and stocks are normally viewed as shares of limited companies that are listed on the exchange. Okay. So, now having discussed the concept of debt and equity in some detail, we come to an exciting new area, which is derivatives. At this point, I will not go into a lot of detail in talking about derivatives. The objective now is to simply introduce you to this area, this field, which is the buzzword of modern finance, and which forms the most important, I may say, the most attractive segment from the investor perspective of various investment avenues. So, what are derivatives? What are the various fundamental types of derivatives? What are their applications? Why they are so special? And these are some very interesting questions, which I will briefly touch upon in today's lecture, but of course, I propose to devote about 1/3 of this course to a detailed study of derivatives, but that will be coming after we talk about bonds and equities in detail. So, starting with derivatives, well, to give you a backdrop, derivatives on the one hand are very appropriately known as the wild beast of finance. Why they are termed as wild beast of finance is because derivatives have been attributed to or have been held responsible for numerous massive scandals in the financial market, scandals which have wiped out billions of dollars of investor wealth in a very small intervals of time. For example, you can talk about Enron, you can talk about Lehman Brothers, you can talk about the Peabody scandal, Kidder Peabody scandal. There are so many others as well. Even the Enron, as I mentioned just now, is attributed partly to the mispricing or the mispricing of derivatives, or misprovisioning rather of the losses that may possibly be arise out of derivatives. That is a technical, highly technical aspect, but the point is that several scandals that have rocked the financial world have been attributed to the use or the misuse, the abuse of derivatives. So, let us see what derivatives are. Well, derivatives, as the name signifies, that is a financial instrument that derives its value from another instrument. Derivative comes from the word derive, and derive relates to the derivation of what? The derivation of value of the financial instrument from another instrument, and that another instrument is known as the underlying. So, a derivative is a financial instrument that derives its value from the value or the price or the worth of another underlying instrument. Now, to cite examples of what these underlying instruments can be? Well, these underlying instruments can well be equity stock, can well be stock indices, can well be interest rates, can well be real estate, can well be commodities, can well be bonds, and whatever that can well be treasury bills as well, government bonds as well. So, there is a host of multitude of instruments, of not only instruments, but other underlyings that can form the underlying of a derivative instrument. And the derivative could be written, a derivative contract could be written on any of these instruments, and it could be traded accordingly if it is listed, of course. We will talk about that as well. Now, the fundamental types of derivatives, well, there are 4 fundamental types of derivatives that we normally encounter, that we normally study at this level. They are forwards, there are futures, there are options, and then we have swaps as well. So, these are the 4 fundamental types of instruments that are usually present in the derivative market. Now, talking about derivative at a more formal level, we can discuss the definition of derivative in the IFRS, the International Financial Reporting Standards. The IFRS Standard 9 defines the derivative as a financial instrument with all the 3 of the following characteristics. That means, it needs to have each and every one of these following characteristics. Number 1, its value changes in response to the change in an underlying variable. It is dependent on the change of an underlying variable. The value of the derivative is dependent on the value of an underlying variable. And then that underlying variable may be price, it may be an interest rate, may be an index of prices or rates, or may be credit risk as well. Innovative derivative instruments are being created using credit risk as the underlying factor. The second point that IFRS 9 requires is that derivatives require no initial net investment or a very small initial net investment, which is in comparison to the other instruments that have similar risk return characteristics. So, derivative instruments require in order to take a position in a derivative instrument, for example, a forward or a future, you need to make very little investment compared to other instruments like spot instruments. If you are to take similar positions in spot instruments or instruments that have similar risk return characteristics. And derivatives are invariably settled at a future date. So, in the context of derivatives, we need to take account of 2 dates. Number 1, the date on which the derivative contract is initiated, the date on which the investor takes a position in the derivative contract, and number 2, the date on which the contract is actually settled. So, I reiterate that there are 2 important dates, 2 fundamental dates in relation to derivative contracts. Number 1, the date on which the contract is negotiated, the date on which the contract is agreed upon, or the date on which the investor takes a position in the contract, and number 2, the date on which the contract is actually settled, the contract matures. This date is called the maturity date. The date on which the contract is settled, the date on which the contract matures for settlement is called the maturity date. Okay. So, now as far as the price of the derivative is concerned, I just mentioned that the price or the value of a derivative depends on the price or value of the underlying asset. So, the price of the derivative at any point in time, say where t is in any arbitrary point in time, small t, can be written as a function of st, where these symbols are commonly used. So, they shall be used throughout this course. St is the instantaneous price of the underlying asset at time small t, and t is a point in an arbitrary point in time at which we are trying to price the derivative. So, the price of the derivative P t is equal to is a function of the price of the underlying at that point in time, and it is also an explicit function of time. I will come back to this point. Why this explicit functionality of time is included in the definition of the price? Well, there is a reason for this, and the reason for this is here. We normally express the value of a derivative, or we normally obtain the value of the derivative by discounting, that is working out the present value of the expected future cash flow arising at the maturity of the derivative contract, that expectation value being calculated with respect to a set of probabilities which are known as risk neutral probabilities. A slightly technical definition, let me repeat therefore, the price of a derivative at a given point in time is the present value of future cash flows, present value of expected future cash flows that arise from the derivative on the date of maturity of the derivative, that expected value being calculated on the basis of a special set of probabilities. That special set of probabilities is known as the risk neutral probabilities. Now, because when we calculate present value, we always use time, we have to come backwards from a future date to the present date by discounting, by the process of bringing back the cash flows from a future point in time to the current point in time, which involves obviously the use of time, and therefore, the explicit, which is again which is a function of time as a matter of fact, and therefore, we have to use time explicitly while defining the price of a derivative contract. So, common applications of derivatives: speculation, hedging, arbitrage, changing the nature of asset and liability. I will explain them briefly, but after the break. Thank you.